Welcome back to Real Estate Mindset. Good morning. Happy Tuesday. Welcome to another morning live where everything will be chaptered in this video so you guys can come back here, take a look at the overwhelming value that we plan on giving you. But before I begin, I wanted to say good morning to everyone. Merlin, good morning. Thank you for the date shout outs. Chris, good morning as well. Ohio Housing Nerd, keep rocking with that property tax battle that you're doing. Good morning to you, sir. It's nice to see you. Night Cry, nice to see you. I know you messaged me on Discord. Sorry I haven't got to that. I am so behind right now. And Austin, good morning to you as well. And there's my man Vovo. You guys, when I send out and put out an edited video, my man Vovo is almost always the first person to say hello. So if you guys see Vovo in some of the videos, say hello to Vovo. He's a good person. Also, P Nice. This is my buddy P Nice. Look at his logo, Mitch. He has the Real Estate Mindset logo. I really appreciate you guys. I appreciate the community so much that you guys are the ones that keep me going. Richard G, good morning to you as well. Cool little spaceship right there. Good morning, Ohio. Dean, good morning as well. It's so funny. Be nice. So funny. Mitch Vex. Oh, there's Charles. It's been so long. Where's Christy at, Charles? Austin, where's Christy at? Good morning to you, buddy. Good morning, George, as well. I really appreciate you guys so much. Really do. Mitch Vexler, happy Tuesday. Good morning. How are you, sir?
Good. I was just watching the chart a few seconds ago, and silver's about the top. And probably today or tomorrow, about 40. And so the metals are definitely running. And, platinum is up. You can't even get platinum. If you try to place an order, it's very difficult to find. So physical, but markets are definitely running.
Yeah, I can't wait to show everyone that. I want to just a couple more people. Justin, good morning. Orange, good morning. You cannot come over for dinner yet. Maybe eventually when we get to know each other. I'm not saying like permanent no, but just temporary no. Monica, thank you for all you do. We see you behind the scenes helping the community. We see you guiding people. We see you helping us to eliminate property taxes. Thank you so much. And by the way, you guys, we will have a property tax segment into this video as well. Good morning, TA. Definitely appreciate you. So let's get started, y'all, with our market update. And what I'm going to do, let me do our first timestamp, is I'm going to bring up a few different market indexes. Why is my camera not on? I'm going to bring up a few market indexes. And I'm going to show you guys basically over the last year on what did the best. So I'm going to look at the Dow, the NASDAQ, the S&P. I'm going to look at silver. I'm going to look at gold, and then I'm going to look at a little bit of crypto as well. And I wanted to show you guys, and by the way, all of those things that I just mentioned are blowing the doors off of 401ks and pensions. I hate to say this, guys, but in my opinion, if you got a 401k and you got a pension, I got to really be careful saying this because I don't mean to hurt anyone's feelings, but a little bit of a clown, because remember, they're taking all your profit in the form of fees, right? And commissions. And so every other thing that you can invest in literally does better than a pension and a 401k. So I think it's important to look at this information. Let me throw it up on the screen and we'll get started right here. And let's get started with the Dow. So Dow opening up, let's see here. Is this updated yet? So it's about sideways, but I wanted to show you guys the 1 year. Okay. So I'm going to start with the smallest increase to the largest increase. And again, I'm going to show you guys about 7 different things. So starting with the Dow, you guys can see right now that the Dow is up 9.67% in 1 year. So if you invested in an index that follows the Dow, maybe you're up double digits, close to double digits in 1 year. When we keep going here and we look at the S&P 500, which is basically sideways as well, but it is having a better return over 1 year than the Dow, which is indicated right here. It is up over 1 year, 13.46%. The leading of the three is the NASDAQ, which is sideways as well, slightly down this morning, but it is up over 1 year. You guys can see this right here, 16.38%. So if you did invest in some of those indexes over the last year, you guys should be up. Now, the number 4 place is actually silver. And by the way, silver, I mean, this is crazy. I don't know what's happening. So silver starts doing a run at about 8 o'clock, depending on if it's Eastern or Central, but I'm talking Central. And look at this run. So it was actually pre-market, it was down, but up again here. Silver's at 39.56. You guys know, while doing a live video, I started investing a little bit at a time into silver. And so far, it's been doing pretty well, but I'm doing that to hold for a very long time. So I'm not doing it to sell, I'm doing it to hold. But silver is up, you guys, close to 35%. in just 1 year. When we look at gold, gold also up this morning. Look at that. Look at that trajectory of gold. I mean, shooting straight up. Gold's at 3,425. Over the last year, gold is up, beating silver 42%. So gold up 42%. Now let's go into crypto. I'm going to show you guys two different cryptos because it's worth noting. I'm not saying invest in it because what the heck is crypto? It's literally not collateralized. But I don't know. I mean, is it worse than the dollar at this point? I don't think so. The dollar is absolutely destroying people. But look at Bitcoin over the last year. And by the way, Bitcoin's at 117,000. But over the last year, Bitcoin has gone up 72%. So just pointing that out. Now, it's really crazy if you're talking crypto. And I don't invest in crypto. I'm just pointing this out. XRP, take a look at XRP. XRP, my gosh. I mean, the run on XRP over the last, couple of weeks has been astonishing. XRP now at $3.51. And again, I'm not telling you to invest in this, but XRP is up over 1 year, 471%. That's, triple digit, 471. So you almost have 5 times the come up on XRP. Again, I'm not saying invest in it, but of the things I just showed you, XRP is by far leading the way. Again, not saying invest in it. If I'm only investing in something physical, right? Like gold and metal. Now, as far as the 10-year treasury, the longer end of the yields, which really affects us as consumers, this really kind of matches residential mortgage rates, is now sitting at 4.36%. So down almost a full 2 basis points, not quite 2 basis points, basically sideways. Very, very interesting. I'll show you guys mortgage rates here in our next segment to show you how essentially mortgage rates have been the same for 2 years. A little bit more than 2 years, actually. Literally, they have been basically the same. About a percentage point up or down. Now, I also want to show you guys the 5-year break-even inflation rate, which is 2.59%. So the market is saying 5 years from now, being, again, that we have quantitative tightening. Thank you so much, TA. I will get to your comment here in a second. I really appreciate that support, brother. But the market is saying 5 years from now, we're still going to be at 2.49% inflation. Remember, the target rate is 2% before lockdowns. It was under 2% right now. It seems to me the whole goal of 2% inflation is out the window. It's out the window because they keep printing money and the inflation keeps going up, and the market sees that as indicating this 5-year break-even inflation rate. I mean, it has been going up. It's an absolute shame. Absolute shame. Inflation obviously is a hidden tax. It is a wage gap accelerator as well. Now here's CMT Fed Watch. This is what the market is anticipating is going to happen with the federal funds rate or the 1-day rate. Essentially, they're saying when the Federal Reserve meets July 3rd, is it July 30th, I believe, they're not going to cut interest rates. They're also saying in September, about 40% chance of no rate cut. But when I go to the end of the year, the market is saying there's only a 6.1% likelihood, or 6.1% of the market is saying no rate cut the entire year. Obviously, generally, and we're going to go to Mitch here in a second, but generally they're going to cut rates if the economy needs to be stimulated. But it's hard to say the economy needs to be stimulated when they're already stimulating the economy. Here is the updated national deficit spending for the fiscal year, which is over in October. So this is not up yet. Now, we've heard reports where they finally had a positive. That's great. But when we really look at the deficit spending, meaning the government is spending the money that they don't have, and we're going to be taxed on that because we have to service it and we have to pay it off. The amortization schedules on this amount doubles this debt, essentially doubles this debt, if not more. And we'll show you that here in a second. But the thing that's the problem, guys, is this is still $64 billion higher. And this is with Doge cuts, by the way. So Doge has been making cuts. They've been apparently saving money. We are still higher. The deficit is still higher than last year by 5%. So although these may be some good things, it really doesn't matter if they still are spending recklessly like this, if they're still creating inflation. You guys are seeing the inflation for the fiscal year on your screen right now. This is an absolute atrocity. And it's not just the spending, you guys. They also have mechanisms in place. The Federal Reserve has mechanisms in place to allow a backstop to banks. And remember, the banks are the ones that are gaining the wealth, right? The Federal Reserve is a backstop to the banks. Generally, when there's some type of package passed that is aimed to help consumers, all that's really doing is helping the banks, to be honest with you. And one of the reasons why we haven't had a price crash or correction that's been a nationwide long-lasting event is because of what you see on your screen. They're saving these banks, and the banks can afford to hold on to this paper. In other words, they don't have to short sell these houses yet because the banks have quantitative easing right now. In fact, what's so interesting is they have too much quantitative easing. They're literally at maximum capacity with an inability to absorb all of this inflation. So it's very, very interesting. I'm going to tee up our video here. And let's see here. Let's get this video set up. Now, Mitch, we're going to listen to a video on consumer sentiment. And I want to listen to this guy because this is CNBC nonsense. I'm sorry. I know it's nonsense. All right. I get it. Okay. It's a bunch of nonsense. But I want to listen to his perspective, CNBC's perspective on consumer sentiment. And then I want to listen to your perspective, Mitch. And I kind of want to just compare to what CNBC is saying compared to what you're saying. But the first video, you guys, and I'm going to make the timestamp here, is on consumer sentiment. So if you guys can, let me know the audio is okay.
Next, let's get to Rick Santelli. Hey, Rick.
Yes, Carl, markets are moving on this. Some big news here in University of Michigan sentiment. 61.8 is the headline. Better than expected, sequentially higher than 60.7 the rear view mirror. That's the best level since February. Very solid number there. And if we look at the current conditions, 66.8, well above the 64 we were looking for. That's the second best number of the year, which means, of course, we're comping to January. Finally, if we look at expectations, what may lie ahead, also better than expected, also sequentially higher than our last look, 58.6, the best since February this year as well. Finally, maybe the most important numbers that I believe the long end is going to like in terms of maybe a little more buying coming in, pushing yields down. The one-year inflation rate moved from 5% down to 4.4%. 4.3 is where we were in February. There's where your comp is. But we did in May have 6.6. That was the highest since 81. I do believe those were some distortions by some of the surveyed respondents. And if we look at the 5 to 10-year inflation, it moved down from 4% to 3.6. That also would comp to Feb when we were at 3.5. So better than expected data. We did see a little buying on the long end of the curve. We did see a little pop in the equity markets, but there's a lot of moving parts here. Maybe the most important thing I would pay attention to for the rest of this Friday is the dollar index. Last week, it closed at 97.85. Right now, it's at 98.14 and change, down about 0.5 cent. If that starts to go negative on the week, that would be very significant.
All righty, Mitch. I'm gonna go to you, and then we're gonna go to T.A. Chapman, who gave a super chat. But what do you want to say in response to this gentleman? And also, I agree with this comment. This dude just does not age. I mean, he looks younger than me. Absolutely insane. This guy. I mean, how do you reverse age? I don't know how many supplements. Anyway, I won't go there. But Mitch, what is your response?
Okay, so the dollar index, that's the DXY. That was what he was just referring to at roughly 98. So it's 98.5 as of the close of July 18th. The DXY averaged approximately 93.15 during Obama's presidency and 100 through Biden's tenure. Now think that through for a second. All this talk in the marketplace, and in truth, it's flatlined. Right? Dollar goes up, dollar goes down, but the measurement is literally flatlined between these presidencies as of today. So you can't say that the dollar is in a collapse. That's a narrative. And when people say, well, this is going to be bad, it's going to drop down a 0.5 basis point, whatever. No, it's not. I mean, there's a big spread between 93.15 during Obama and 98.5 right now under this administration. The truth is that the problems are more geopolitical. So gold and Bitcoin are a reserve value. That's probably the best way to look at it, as an alternative to the fiat currency. But it can't replace the US dollar because there's not enough of them to go around to replace the US dollar. So the metals are running out of more geopolitical fear than US dollar currency fear. And I made a comment a while ago that the US dollar is a bad kid on a really bad block. And I stand by that because if you look at what happened with the euro, do you know that last year the euro was almost at par with the US dollar? So it's now having a reaction because the cost of the euro is less than our US dollar on an interest rate basis. So in Europe, they're lowering their interest rates, and that's pushing the value of the euro up. So you go from par to where it is right now on the euro at 1.13, 1.14. So it's climbed back up. It's a reaction. And I also want to point out that Bessent came out, I believe, yesterday and said, well, we're going to lower the interest rates because that's great for the housing market. That statement is half-baked at best. It could be, but the real problem is the real estate taxes. And I actually put an amortization schedule together last night to prove it.
Do you want me to throw that up?
Okay.
I'm going to throw up your chart. Mitch made this last night because we've been hearing what they've been saying. Yeah, we need to lower rates. It's going to help the housing market. And we're like, huh? And then Mitch made this for him. So go ahead, Mitch. It's on the screen now.
Okay, so this is a loan amortization schedule, and just follow the thought process. So if you have a loan at 200,000, you have a loan at 200,000, and you have 7% interest rate. Now remember, when you see the U.S. Treasuries flashing up on these screens from CNBC, you can't borrow at that money. That's Fed funds rate. That's money between the banks plus or minus 0.10% for fees in between. That's what the Fed steals. So your annual interest rate, let's just call it 7% for the sake of conversation. 30-year loan, number of payments per year, start of the loan, 8/1/2025. Okay. So to make a long story short, because I want to cut right to it, that payment is $1,330 per month. If you had a $200,000 loan, that's what you would pay. Here's the issue. So at 7%, it's $1,330. So I said, okay, fine. Let's knock it down 3/4 of a basis point, 3/4, 0.75. That brings that payment down to $1,231 a month. The difference is $99 a month in that person's pocket, in theory. Here's the problem. They lowered the rates 3/4 of a basis point, which they're not going to do. But again, follow the logic. So the yearly difference is $1,190. Take the yearly difference divided by 0.022, which would be an average tax rate across the United States for the sake of conversation. So the increase in taxes from your CAD would be $54,000. The net effect of money in your pocket by lowering the interest rate is zero. Now, let's take it to an extreme just for fun. And let's say, well, we were at 7%. Let's knock it down 200 basis points. Never going to happen. So the savings there, you would drop down to $256 a month, allegedly in your pocket, $3,000 per year, $140,000 tax increase. So then you would have to ask, well, what are the odds of a $300,000 home having a $140,000 tax increase at roughly 30%? Well, my home went up 65% in 1 year. And the point of what I'm getting at here, if you look at the title of this is called loan amortization. No governor. There is no prohibition under the CAD's fraudulent, illegal, nonsensical BS rules where the CAD cannot raise the taxes to infinity. And on one of these videos, I asked that exact question to Don Spencer. Mr. Spencer, what is to stop you from raising the taxes in 2025 to infinity? Well, we're seeing across the state of Texas problems everywhere. We're seeing problems in Ohio, Pennsylvania, Missouri, you name it. We're seeing it. We're getting data coming in. This is a con. What they have done is a con. It is a fraud. It is financial crimes against humanity. And this little spreadsheet here, as simple as it is, proves that Bessent's comment is, like I said, half-baked at best.
Right.
You're not going to see 10 cents out of this.
And so to reiterate what you're saying, and correct me if I'm wrong here, and I'm going to throw this comment up because this comment ties into what you're saying. Essentially, we have a government official saying that everything is going to be fixed if we lower interest rates. And we're like, no, it's not, because we have all these other problems over here. And your property taxes, not even counting your homeowner's insurance, is going to go up even more than the interest rates going down. It's not going to offset each other. We have other problems we need to fix. Obviously, prices of houses are a problem, right? Income not going up is a problem. But essentially, you're saying they're putting the cart before the horse here. Just like this comment, Ray Taylor saying they already did property tax relief. Are they going to do more? They never did property tax relief, Ray. They gave us an additional $40,000 homestead. We already had $100,000, so they gave us an extra 40. But my home is overassessed this year by 60,000. So they give me 40 reduction, but they're increasing it by 60. So it's a horrible gimmick. I want to put up the super chat. I'm gonna take that off the screen there, Mitch. I'm gonna put up the super chat real quick. This is from T.A. Chapman. Appreciate the $20, brother. Really do. Fight for property taxes. We are certainly doing that. We fought our Alaska property tax up to the state Supreme Court to get it changed a few years ago. Might help with the fight in Texas or the federal government. And that's from Haynes. And I appreciate you, sir. I just, since you brought that up, I also want to tell you guys, and I want to show you guys, if you go to real estate, let me remove this real quick. If you guys go to realestatemindset.org right here, I have a new tab up at the top right here that I want you guys to go to. It says tax protest criminal complaint. If you click this tab right here, it's going to bring up exactly what happened to me. I was physically assaulted during my protest hearing at the ARB. Okay. They closed my meeting illegally when I still had time. They physically assaulted me in the hallway, and then they trespassed me. You guys can see the trespass notice here. This is the guy that assaulted me. Here's his citation. And more importantly, here's all the evidence. So if you guys want to see the evidence, I have body cams. I have audio with the police chief. And then I also did a timeline here of just dates, 7/16, 7/17, 7/18. And I linked the dates and I linked the audio. I did all of that type of stuff. Now, I didn't want to get too much off track there because we're going to go into that here in a minute. But we are now in the process of finding, and again, I appreciate the support, brother. We are in the process now of finding a civil rights attorney that understands federal and state civil rights. So we've started doing that. I will be retaining an attorney to fight this. They've invited me back in to protest my taxes on the 13th of August. And I'm like, you guys are entrapping me. How are you going to invite me back, but also have a criminal trespass? And first of all, how are you going to issue a criminal trespass? The person that issued it against me, I never even spoke to, and I never even committed a crime. It's an absolute atrocity. I cannot believe that they're doing this to me. Very, very crazy. I'm going to keep going. We're going to do our mortgage update now. And I'm going to show you guys how mortgage rates work so that when you guys are eventually shopping for a mortgage, you're going to know how to properly shop for it, right? So let's go into that right now. Here's what mortgage rates are doing today, sitting at 6.78% for a conventional. Really, there's one main financial reason why conventional is better than FHA. You guys will note that FHA has a lower rate. The rate that I'm circling is an FHA rate. So FHA is at 6.375. You should be able to get that lower if you shop. And then a conventional is a higher interest rate of 6.78. So the only advantage from a financial standpoint of conventional, being that it has a higher interest rate, is your mortgage insurance. If you put 20% down, or when you get 20% in equity or 22, it will be automatic. Your mortgage insurance automatically is removed for conventional. On FHA, it will last forever unless you have a 10% down payment. Then it will only last for 11 years. My point in telling you this is you really got to weigh out what you want to do. You can't just say, oh, just let me get the lowest interest rate. I'm saying that because it's not necessarily the best deal just because the interest rate is lower. You also have to look at your mortgage insurance. It's PMI with conventional, it's MIP with FHA. All right. But those are the interest rates right there. If you have probably credit under 680, your interest rate's probably in the 7%. But remember, you guys shop your mortgage. You have a grace period when your credit is ran for about 30 days. Generally, a broker is going to have a better deal than a direct lender because generally a broker has lower overhead. Now, here is the demand for mortgages right now. So refinance, it has ticked up a little bit. It's still in the dumps, right? I mean, because you can't refinance into a higher rate. Why would you refinance into a higher interest rate except for getting cash back, which is a horrible thing to do. But when we look at the purchase applications, I mean, it's still just absolutely crazy low, ticking up a little bit. So it could be seasonality, not 100% sure, but it's slightly year over year, it's ticking up. Now we should be way up here looking at the blue line. We should be way, way up here. or even before lockdowns, here was the average, okay, way up here. And right now we're way down here. So demand is absolutely horrible. Now, remember, you guys, there's two main things that I want you to remember other than the CIA when it comes to the housing market and purchasing real estate. One is comparables and comps, and we'll get to that. But the other one is amortization schedule. You really need to get your mind wrapped around what an amortization schedule is, because it's a financial death sentence. It is a financial trap. You pay all of your interest before you pay off your principal. Your true interest rate on a mortgage is more like 120 to 140%. The only way to really not make the banks rich and to get yourself out from underneath a mortgage is not to refinance unless you're shortening the term. So don't refinance. If you refinance, you start this whole thing over again, but you got to pay money towards your principal. Okay. Now here's an example of a $500,000 loan on a 30-year fixed rate of 6.78%. If I borrowed $500,000 and it took me the 30 years to pay it back, I'm not paying back $500,000. I'm paying back $1.17 million. Now, I want you guys to also understand this is the same way debt works with the Federal Reserve, with our federal government, and with the ISD bond debt. So even though they say they only owe, as you see here, $500,000, in order to pay that off, they have to service that debt. The reality is they owe $1.1 million. That is how bad amortization schedules are. Now, I wanted to show you guys this. This is very important. Okay, if you want to save 5 years, okay, if you save 5 years of interest in this scenario, that's 160,000 roughly. It's more than that, but we're going to round down to 160,000. If you want to save $160,000 on your mortgage, what you would have to do in this scenario is you would have to pay the loan down from 500,000 to 470,000. Meaning if you paid, let me put this blue, if you paid $30,000 down on your mortgage, not your house, on your mortgage, not only do you save 5 years, you save $160,000. That is how important it is to pay this off. Now, also, when you make optional extra payments, if you do biweekly, remember biweekly is just one extra mortgage payment per year. If you double that and you do 2 extra mortgage payments a year, so that would be $6,500. Okay, so if I did $6,500 extra per year, let me calculate this for you guys. You save 10 years off the loan. Right? So you can literally take a 30-year mortgage and turn it into a 20-year mortgage without refinancing. You would also save, if you did what I'm saying, you would also save over $250,000. You would save $260,000. Isn't that amazing? I mean, again, amortization schedules, pay attention, understand how they work. Now, another thing I want you guys to understand is how mortgage rates work. Remember, mortgage rates don't go up and down every day. The pricing or the cost of those mortgage rates is what change every single day. And that changes with lenders as well. Some lenders may be the lowest interest rates, and then a week goes by and they're the highest interest rates. So it's really important that you keep shopping lenders to see what their pricing is, because pricing not only has to do with these LLPAs, I'm about to show you LLPAs, but it also has to do with something called an SRP, which is a service release premium. Back in the day, we used to call it YSP, which was a yield spread premium. Okay. What that means is commission. They pack commission into your interest rate. Do you understand? So if you're working with a lender and they give their loan officers 3% commission, guess what? Your interest rate is going to be a lot higher than if you went with a broker who only pays their people $500. Do y'all see what I'm saying? So they pad the interest rate. You can tell with the pricing. And what you guys see here is a loan level pricing adjustment, an LLPA. Okay. This represents a discount point. Now, this is a pricing adjustment for FICO score and down payment. So you guys can see if someone has a 720 FICO score right here and they have less than 20% down, they're going to get a hit of 1.25% to the interest rate, meaning just this scenario is going to cost 1.25%. So if your loan amount is $100,000, 1.25% of that is $1,250. So just this LLPA alone is a cost of $1,250 in that scenario. Now, that goes with everything, by the way, guys, FICO score, savings, all of that. But this is more importantly, this is a rate sheet that you're looking at here. And I'm going to test you guys, okay, in a second. But what you want to do normally when it comes to interest rates is you want to get to par pricing or an interest rate that does not cost you money. In order to do that, you want to get as close to 100 as possible. So 100.000. And the reason that this is highlighted is because this is the closest to par. Actually, technically, wait a minute. This is the one to the right of that's closer to par. Technically, but either way, they highlighted this because it's the closest to par. Anytime the rate pricing is over 100, that is called a rebate, meaning you get that money back. Okay, so in this scenario, you would get back 0.097% of the loan amount, which is almost nothing. But if you look at 99, if you go under, if you want a lower interest rate, so 6.125 is par. If I want to get a 6% interest rate and I want to lock this interest rate for 30 days, okay, then in order to get to 100, it would cost me about a half a point. Okay, so I'll show you an example. This is a little bit complicated, but once you really kind of just wrap your mind around it, it's really easy. So right now, this is what the pricing is, as you guys see here, for 6% on a 30-day lock. All right, the difference between this number and 100. Okay, so let's just see what the difference is, because remember, we got to get to 100, is 0.44. All right, so I would take my loan amount, if my loan amount's 100,000, times 0.044 equals a cost of, I'm sorry, it would be $4,400. It would be 0.0044. So it would be $440 cost if I wanted that. Okay, so hopefully that makes sense. Just rewind this. I just should have added another 0, but that's essentially how it works. Now I'm going to give you guys a test. Okay, here's your test on the screen right here. These are 2 rate sheets. So if you're shopping a mortgage, you're going to ask your loan officer every single day to give you a rate sheet so that you can track the pricing of interest rates. So here's 2 rate sheets. On your left is a Fannie Mae 30-year fixed and a Fannie Mae 15-year. So you have a 30-year and you have a 15-year loan. Now on this one, in the comment section, if you guys can, on the 30-year, tell me what rate is the closest to par on a 30-day lock. So the 30-day lock column is here. And then tell me what the closest to par is for the 15-year on a 30-day lock as well. And if you guys can, just comment in the comment section below on the 30-year. Tell me what rate is the closest to par on a 30-day lock. If you guys can, do a 20-year versus 30-year. Here you don't move. Okay, so if you guys can, tell me if you guys got that. I'll give you the answer to the first one. Okay, so on this, on a 30-year right now, the closest to par when we're looking here, remember, we got to get close to 100, right? Which means the closest to par on the first one is 4.625, because look at, I get a slight rebate or refund because it's slightly over 100. Do y'all see that right there? Now, looking at the 15-year mortgage, 15-year fixed, what rate is the closest to par without being charged money? Okay, so without being charged money, someone is saying 4.625. That would be on the 30-year without being charged money. But what about the 15-year? So we got a 4.20. We don't have 4.20, but we have a 4.125. Okay, so 4.125 is it. You guys see that this 4.125 is the closest to par without being charged. But technically, the closest to par is the 4% rate because it's closer to 100. But the problem is it costs money. It costs about 110. Actually, it doesn't say in this case because you're only being charged 0.002 of the loan amount, which is probably less than $200, right? So I'd go the 4%. But in essence, guys, I don't want to confuse you. I just wanted to give you guys kind of a roundabout idea on how mortgage rates work so that you don't get taken advantage of by a loan officer. So you guys can rewind this. You guys can watch that again if you want. I'm going to move on to our next video real quick. We're losing a little time. And by the way, you guys, I have a slight cold, so I'm sorry that my energy is down today. But I'm going to bring up, okay, next video is regarding the mortgage market and Vintage Score. You guys have been hearing a lot of things probably about how you can use rent to qualify for a mortgage and things like that, but we've already been able to do that. So all of these people like this hoopla, like, yeah, it's going to be easier to qualify for a loan. It's like, you guys don't understand. We could already do that. It's propaganda is what I'm saying. If there's some loophole, maybe they added it to conventional DU instead of LP, right? But we could always do that, at least for the last 5 years, So half a decade. So this is nothing new. But listen to the CEO. He's going to talk about vintage credit score and the fact that, did you say something, Mitch?
Yeah, just a couple of things. I want to step in here just for a second. That person who mentioned the Supreme Court challenge on Alaska, would you please send me that document? We actually have somebody who is a major landholder in Juneau, Alaska, and that may be important what you've got there. Over and above that, the interest rate or the interest problem at the central appraisal districts and the compound interest. So it's compound cumulative on the ISD debt. You have to realize that that compound cumulative adds to the new bonds, which adds to additional interest rates. So for anybody that's out there, if you'll go and look at the Godly PDF, so that's the Godly spreadsheet. I turned it into a PDF, and that was attached to the bill that I delivered to Helen Kerwin. Then Travis was showing you on the amortization schedule what happens if you buy down your mortgage over time with an extra payment. I want to point out that give or take, you're now making money on your loan. By buying it down, it's roughly 4% per year that you're actually making on your money. And that's a much better investment than a CD because that lowers your liability in addition to putting more money in your pocket. So then he was talking about the difference, and I wanted to point out from a market perspective, like if you're in stocks or bonds, you have what's called the bid-ask spread that you're trading in the futures world or in the options world, right? You get the bid-ask spread. Well, that's the exact same thing on that chart that Travis was just showing you. That's the bid-ask spread. That spread is the fees in the middle of what somebody's going to charge, be it the broker and or the lender, because lenders also get fees built in. So the bid-ask spread, that's what those people are charging. Then over and above all that, the debt-to-income ratio, as originally required, I'm not sure what it is today, but it was 28. They'll go as high as 35, which is just stupid. Do not get into trouble buying a house. 0.28 is out and out absolute max. I completely disagree with it, but follow the logic here for a second. We ran the math, and the real DTI, due to the inflation, should be closer to 21, not 28. These people that are doing loans at 35, 40, 45, as far as I'm concerned, it's out and out criminal because there's
50.
a higher probability you will lose your home.
Some are doing at 50 front end. Front end, meaning just mortgage and income. That's front end. Back end is with debt, but conventional, you can go to 50 with compensating factors, front end debt to income ratio. FHA back end debt to income ratio. So with credit cards and car payments, 56.99. And what I try to explain to people, that's gross income. That's not net income. That's not real income. They don't use real income to qualify for a mortgage. They're using gross imaginary income. How could you do that? Unless it's a VA. A VA is the only loan that will do that will take all the expenses, called a residual income calculation. So VA is the only one doing that.
So off the top of my head, mathematically speaking, if one of the spouses loses a job, that 50 turns into 87.
Yeah.
You're bankrupt. You're literally bankrupt if if a spouse loses a job. Over.
Well, and what about your spouse doesn't lose their job? You max out your debt to income ratio like most homeowners do, and then your property taxes go up 40%. Your homeowner's insurance goes up 30%. Then you're like panic. Then it's panic mode because what you thought was going to be the cost is no longer the cost. It's much higher now, and most people don't prepare for that increase. And loans aren't underwritten for future increases in expenses. Loans are underwritten with a screenshot. Like, all right, we're going to take a screenshot of what's happening right now. And that's it. They don't look at future tax increases. They don't look at future inflation or insurance, because if they did, then everyone would know we shouldn't be underwriting loans at 56.99% debt to income ratio. I mean, that's not rocket science, right?
No,
We've already gone through this.
That's criminal. I mean, it's just straight up criminal. They've got no business doing it because they're setting up their clients for imminent failure. So the 21 DTE, that gives you the margin of safety to weather the storms. And what's happening out there, if it's above 28, there's every notch up above 28 puts you that much closer to losing your home.
And I may show you guys, I actually put I didn't tell you yet. I haven't even recovered from Kerr, from doing the flash flood recovery in Kerr. I haven't even recovered from that. But I did put in a verbal offer for a house. When did I do that? Sunday? So 2 days ago. And it was a disrespectful offer, and I am always going to be disrespectful. And what I mean by that is it was a really low offer, right? I tried to get the house at $80 a square foot, and I was at about 35% wedge, but we were off by about 15,000. And I told Sherry, because my wife wants to get a house, you know, she's like, we need a house. I'm like, I know we do, I know. But I was like, look at what's happening. This is going to be happening for years. People are already struggling. The longer that we wait, the better deal we get, and we will not settle. But if the number and the math works, we will go after that house. And this house is being sold for really low. It's just not low enough, right? I want it to be even lower. Like, I want to be disrespectful. I want it so low. I've been waiting a long time. All of that to say, here's our next video. Okay. Vintage credit score. If you're thinking that this is going to help you, trust me when I tell you guys, it's not. The only thing that can help you is you. And what I mean by that is there's no credit card debt, outstanding credit, and money saved. Don't overextend your house buying a house. Be very, very careful. It's a very tricky time to purchase real estate right now. I'm going to tee this up. If you guys can, let me know that the audio is okay.
So data, I mean, tell me more. What are all the myriad reasons why we should use your, I hate to describe it as a looser credit model, to give access to mortgages to more families, more Americans?
Well, of course, Kelly, the opposite is true. I know you were being engaging to ask me that question in that way, but the reality is we ask more data to calculate our score than our competitor. The reality is in 2008, there was only one credit score being used in the marketplace, and that is our competitor's score. We ask for more data because the world has changed, and it's time for a more inclusive, more modern credit score. That's why our credit score is used by over 3,700 banks, including 8 of the top 10 banks, and we grew 55% last year, delivering over 42 billion scores. We asked for more data, and that's the key point.
What would be some examples of that?
Well, you highlighted one of the major areas in your opening comments there, rental data. It's, I think, obvious to anyone. You don't have to be an AI expert to know that the best predictor of a consumer's ability to pay a mortgage is whether they pay their rent on time. The old model from FICO doesn't do that. It's very, very old school in its composition. The reality is when that score was developed, people paid their rent with checks. There was no online banking being used. People sent their bills in the mail. The iPhone wasn't even around. We're in a much different world now where there is data available that can be used to enhance the predictiveness of a score. We've harnessed that data, and it's time to bring that technology to modernize the mortgage credit scoring system. We're really excited about this decision by the FHFA.
A lot of this, when I read it, does seem to come down to this thing about rents and that being counted as part of your credit history. What if there's a situation, Silvio, in which FICO says, you know what, fine, we'll count rents too?
Well, I think the best entity and best person to answer that is the FICO CEO. What I can tell you is that VantageScore includes that data and uses much more modern analytics techniques. If you look at the head-to-head comparison of VantageScore versus our competitor's score, we capture 11% more delinquencies and defaults. Our score is actually substantially more predictive, which is why, of course, the FHFA made this decision. But then you add to that the element of competition. Competition is what makes markets great. Additional data is also a key part of competition. And the reality is the law was signed in 2018 by the president, had strong bipartisan support. They decided to bring competition to this marketplace, and we applaud the FHFA director for finally implementing the law.
Do you have an estimate of, so I guess market share wise, I would imagine FICO still has, huge share. You guys are newer, obviously they've been around for forever, but do you have a sense of if you started to gain share amid all of this, and I'd love to know if there's like price competitiveness stuff here as well, how many more people you think would be able to access a mortgage or buy a home today if these become a viable option for lenders?
That's the most important point. Bringing innovation and technology to the mortgage credit score market, that opens up home ownership to more credit-worthy consumers. To answer your question quickly, it's over $1 trillion in incremental mortgage volume that is potentially available through the implementation of VantageScore 4. That is because we score 33 million more Americans than our competitors. Of that group, approximately 13 million would have a VantageScore of 620 or above. And within that group, approximately 5 million would be eligible for a mortgage, which translates at 1.83 persons per household to about $1 trillion in incremental mortgage volume. That is a big, big number. And it's important at a time where, quite frankly, it's so difficult to purchase a home. So this is about including more people that are actually creditworthy into the ecosystem with modern technology.
With modern technology. Bro Joe, you got me twisted, Bro Joe, talking about Coneheads, which, by the way, great movie, Dan Aykroyd. I love Coneheads. What is it, Narthol, the Garthak? I think. I don't know if you guys saw that. It's pretty funny. So, Mitch, I'm going to tee up our housing market report. Do you want to comment on whether or not we need to have a looser credit model so that more people have the opportunity to buy a house? I remember something about that happening in 2002. Can't really remember what happened, but any comments there, sir?
I've heard this nonsense for the last 35 years, right? You've got Equifax. Look at all these companies that are in the business of credit underwriting, even Moody's. Look what happened in 2007, 2008. According to Moody's, everything was fine. Sky was falling. Everybody's going bankrupt. But according to Moody's, oh no, there's no problem with these companies. Complete nonsense. The credit score system, that's just a monkey in the middle, literally sucking out fees. That's what they're there for. It's about the fees. So his direct quotes were modern analytic techniques, more predictive, additional data. He referred to the FHFA as if to give him credibility. Here's the problem. It's all black box. You literally don't know what's in under the hood. Is there really a scoring system? Or is this all just completely made up? Interesting twist of words, but no evidence because it's a black box. Well, here's the underlying point to all this. If it's a black box, then you don't have the ability to educate mom and pop as to what the targets are within the black box. So in essence, they've created their own circular argument of doom, because if you don't teach mom and pop what is necessary to hit the target so that they will achieve the financing that they need for their house and not go broke in the process, you are a complete waste of air.
Hardcore Mitch, I could tell that you're pretty spicy this morning, sir. Pretty spicy indeed. And I would normally join you, man, but man, my throat hurts. Okay, I'm going to go into the housing market update now. I'm trying to do the best I can. And oh, by the way, you guys, I have a Zillow video for you guys. I'm going to have that released this evening. I'm really trying to get back on track. You guys know I went to Kerr and then the property taxing. I really got off track with the momentum of the channel. So I'll be working extra hard, and in the meantime, documenting what happened in Kerr, and then also continuing with the civil rights violations with my local central appraisal district, where we're going to push as hard as anyone can. We will not let that go, just to let you guys know. And I'll have a segment on that here in a second, but I want to go to the housing market now, guys. Let's start with the inventory. Now, this updated on the 10th, but inventory is over 1 million now. And in the Zillow report that I just did, Zillow is now saying that at the end of the year, we're going to have pre-pandemic inventory, which means inventory is going to go back to normal. But remember, we had this amount of inventory when rates were at 4%, and the average debt to income ratio was probably 35%. So we don't even need this much inventory, is my point, for the housing market to start. And I don't want people to be upset by me saying the word crash, but reset and correct. Okay. But regardless, remember also the house market is also very, very bifurcated. Ohio Nerd brought a good point up as far as the bifurcation. Ohio is not like Florida and Texas. Ohio is just doing its own thing. And that's why it's really important that you don't compartmentalize everything into the broad information we're reporting, and you guys go under the hood with the skills we're teaching you and analyze the market. Now, housing inventory at 1 million 82,000. And I wanted to bring it to your attention. January of 2018 and February of 2018, we had 1,045,000. Now that is the lower end of the seasonality in the housing market. So I understand that, but nevertheless, we have more inventory than we did in February and January of 2018, as well as January 2020, December of 2019, and we get to close to November of 2019. But look at the trajectory. More than likely, you guys will have probably 1, 2, 3 more months of inventory growth. So unless we have some type of something break, and then people could distress sell. If we have distress sell, this will jump up more than likely. But we can't really see that. Like, it's hard to know what these listings are. Right. It's mostly, I mean, you could make an argument that most of it is distress selling, but it's just hard to know what it is. We haven't really seen massive fluctuations. It's been a really slow roll. Now, moving on with the housing market, one of the things that is the problem is the payment, right? But the bigger problem is the price, because you can change the payment. You cannot change the price of something once you've bought it. And what I want to do is I'm going to go back to the global financial crisis, and I'm going to show you guys that homes right now are more unaffordable than they were during the global financial crisis by a lot. Okay, so in order to do that, let me go back to the global financial crisis, January 2006, and I'm going to do a scenario at 10% down. Okay, so at 10% down, during the global financial crisis, according to Zillow, the debt to income ratio peaked July of 2006 at 41.9%. Okay. Now remember, you guys, in 2022 and in 2023, they removed, this is so crazy. I can't believe I'm saying this, but they removed debt to income ratio from Dodd-Frank Wall Street Reform and Consumer Protection Act qualified mortgages. They did that. They removed debt to income ratio, and you can see them remove the debt to income ratio here because the debt to income ratio skyrockets when they do that. Okay, absolutely skyrockets, peaking at well over the 41%, like the global financial crisis, peaking at 46.8. 40. Imagine putting 10% down on a house, and your debt to income ratio is still 46.8%. So you put 10% down in 2023, and then your taxes skyrocket, your homeowner's insurance skyrocket, potentially, depending on where you live. If it's Florida and a condo, your HOA skyrockets. Your debt to income ratio is still high. You're kicking yourself on the butt for putting 10% down, plus the closing costs could be $60,000, $70,000 out of your pocket, burn, gone. My point is telling you this is we have a payment problem as well. And when I say payment problem, obviously it has to do with income. And when we look at Case-Shiller home price growth compared to CPI, Consumer Purchasing Index, you see the bubble. All I wanted to point out here, guys, is there is room, a lot of room for prices of houses to go down when we look at the income, the median household income. When we look at that, there is no dispute that there is room. In fact, most all of us, I'd say, I don't know, 90% of us need, not want, need house prices to go down. And a lot of people, even if they already own, would be happy with that because eventually taxes will go down, and hopefully eventually homeowners insurance will go down. It'll probably be a year to two lagging behind, but everyone wins essentially, unless you're flipping a house. But look at the double bubble. I mean, we have a double bubble right here. And here's the bubble. Okay, you can see the bubble during the global financial crisis. And here's the bubble getting out of control. And then it goes hyper crazy. And then another round of inflation and another bubble created. And again, you guys, it wouldn't be a problem if we all made more money, a lot more money. If we all started making more money and our income increased with our cost of living, this would be sustainable. It would be more sustainable. But the problem is they forgot to pay us our money. They just took our money. Prices of everything goes up, but our wages don't go up. And not only that, the data, they're lying to us about the data. The data that they use, you guys, is propaganda data. I'm going to show you beyond a shadow of doubt that the data they're using is propaganda. Okay, because here's median household income in the United States. This is $80,000. So the average household, whole household, 80 grand. You guys can't even get a mobile home right now for $80,000. If you make $80,000 and you have any debt whatsoever, you can't even get a car if you make $80,000. But here's the crazy thing. When we adjust for inflation, they're saying, so it should be higher after adjusted for inflation, because it devalues our money. But when we adjust for inflation, real median household income is the exact same. That's impossible. When you adjust for inflation, There's an adjustment made. It cannot be the same. They're saying, the government is saying to us, the people, that nominal median household income is the same as real median household income. It's impossible. They're screwing around with the data and they're manipulating us. But look at the real income. You guys can see it went down during this time. It started going up back in 2023. Hopefully it goes up a little bit more, but this is the biggest hole in the puzzle, biggest hole in the bucket. Our income didn't go up and therefore we can't afford it. Like, it's extended because of the inflation, but it's not just inflation. Remember, they printed money and they gave it to us. We got like $6 grand, $7 grand. I don't remember what it was, but they printed the money for us. Now, we're going to go through this quickly. Now, when I told you guys there's two main things about real estate, one was amortization, the other one is comparable data. Here's the Houston market. This is MLS. Okay, there's, I don't know, 50,000 listings. Now, what I do is when I'm putting a search together, I'm starting with the math. Okay, and I'm looking at dollar per square foot. Homes are not valued by price per square foot. Everyone's like, Travis, you can't value that way. Well, I'm not valuing that way. I'm just starting somewhere. This is the starting point, right? And so I just adjusted. I only want to look at houses that are under market value. And so I have a really good opportunity if I lower the price per square foot. Is it guaranteed? No. But it is a great way to eliminate homes that are overpriced. So I changed this to $80 to $120 per square foot. And now instead of 50,000, okay, to where it's like blinding because it's so noisy, now I only have 3,600. And I'm saying, if you're a first-time homeowner and you want to buy a house, don't look at the house that is like a mansion that has everything you want. If you're a first-time homeowner, it's time to sacrifice, right? Get a great deal on a small house that has a lower payment than your rent, and then stay there for however long it takes, 5 years, 6 years, whatever, and then get another house, right? Let it be a step up. But the problem is these first-time home buyers, and also there's not a lot of affordable housing, so I get it. They're not doing what I'm showing you. Okay, so let's look at the map. All right, and I'm going to show you, this is way easier to look at. And I'm going to scroll up and I'm going to show you one of the houses that I put an offer in on Sunday. Okay, so let's go here. All right. So all of these houses, I mean, look at this area. So this is a cluster right here of a neighborhood that has lower price houses. This is the house right here I was going to put an offer in on. Let me show. Actually, I did put an offer in on, but I put it for $280,000 plus closing costs. So it's really, I put an offer in at 270. Okay, so this is the house right here, 270,000. Okay, this is the house, $92 a square foot. That's pretty good, right? $92 a square foot. If I got it for 270, I would have about 35% in wedge. But I'm showing you this because can you guys believe that this house is being sold for $92 a square foot? Is that not crazy to you? This is crazy. It's not all the houses, but there are gems in here that you guys can actually find if you look. But I also want to show you this house. Take a look at this. This is crazy. My wife wanted me to put an offer on this house as well. I'm not going to put an offer on this house, okay? But this house is for sale for $107 a square foot. This is a very nice house. This has been listed on the market for 11 days. And look at the condition of this house. Look at this, guys. $107 a square foot. Look at this. It's completely redone. Look at that. Super nice on the inside. It's not loading the pictures for some reason, but it's very, very nice. $107. They can't sell it. Been on the market for 11 days. But let me show you what it's being taxed on. Because remember, the property taxes that they're creating is being derived from a fraudulent software that subverts both law and math. And so I want you to remember this number, $350,000. Okay, let's look at what it is assessed at. I'm sorry, the market value. So is it 350? It might be. Oh my God, it's not. Oh, this is so bad. This is, oh my God, I didn't know this was that bad. This is really. So if I bought this house, like the first thing I'm doing is I'm working on the assessment value. So the county, because these people are victims and they're not paying attention and they're not standing up for their rights, has overassessed this house by over $150,000. If you're working for the CAD and you're listening to this video, I want you to know that you're a fraud and tyrant and we're coming after you. Okay. And we're not going to let this go because the math is the math. And even if it's a little fraud, it's still fraud. And we're sick of this. Look at this, guys, on your screen right now. Pay attention to what's happening. This is against the law. We can prove this. We just need someone to pick up our case. They can't sell this house for $350,000. It's being taxed at $503,000. And in 2023, it was being taxed at 505. They went up 75,000 in 1 year. I mean, this is crazy. This is what it looks like when you don't stand up for yourself right here. This is what this looks like. So if you don't want to stand up for yourself, be prepared to pay over $150,000 more than what your house is worth. So just one more time. Market value that the Central Appraisal District is saying that this house is worth $503,000. But when I go back to the active listing, the market value, okay, it's on the market, $350,000 can't sell. There's no better way for me to explain the problem that we have in Texas. Now, also, one more time, guys, and I'm going to revert. We're going to go over property tax update, but I wanted to remind you guys, if you want to support us, you can email these people. The evidence is here. You can go to realestatemindset.org, go to the tab that says tax protest criminal complaint. We are going to retain attorneys. All of the evidence is here. This guy assaulted me. Here's his assault citation, but they also criminally trespassed me. Actually, Melissa Rowe Clark criminally trespassed me, and I've never talked to her. So I'm thinking I should probably fill out a report against Melissa for filing a false police report, since she could not, legally trespass me, and I committed no crime. So she's straight up lying. Anyways, so, that's that update. I'm going to pull up your papers, Mitch, right now. And I want you to talk to the viewers. That's going to, actually, I'm sorry. I have a video first. Let me play this video. I'm so sorry. You know what? I'm not going to play the video. I canceled the video. We're going to go in now. We're going to talk about the property tax update. Okay. Now remember, you guys, I just showed you, go to realestatemindset.org. Follow the timelines there. But I also wanted to report on this. Let me put it up on what Mitch has done. Okay. So this is going to be linked in this description. This is a good breakdown that's basically showing you guys that if we eliminated property taxes, then Texans don't go hungry. So Mitch is painting that picture with the math, essentially, because we've got a lot of people saying that if we eliminate property taxes, it's going to disproportionately hurt the poor. And we're like, no, it's not. It's not going to directly hurt the poor. You're going to have lower rent. I mean, if my mortgage payment is lowered by $1,000 because my property taxes are over $12,000 a year, if my mortgage payment drops $1,000, then I can now afford to cut my rent by $1,000. And if I want to be greedy, then I could do $800. My point is, it will help everyone. And so Mitch goes into all that math, but really, and then he goes into compound cumulative, basically saying there's an 11 times come up because they're not paying the debt. I mean, the ISD debt is a huge problem, but really what I want Mitch to talk about is this. Okay, this is a new bill to repeal property taxes. This is currently in Texas Ledge. We're hoping to get this on the floor to be voted on. And Mitch, if you can, I want you to go over your new bill.
Just one other thing before I get into that. So with regard to the inventory that's out there right now, the existing housing inventory, one must recognize that the Airbnb problem is going to ramp up and drive those inventories skyrocketing. So Airbnbs don't work because the cost of the insurance plus the cost of the real estate taxes prohibit the product from actually making money, which means they're going to hit the market and they're going to flood the market. First thing. Second thing is, if Airbnb was sincere, they would be on board literally with their money, forcing the taxing authorities to repeal the real estate tax across the United States in favor of the uniform state sales tax. And they would also form their own insurance company to supply insurance to the users of their system. Just tossing that out there. With regard to the bill, there have been other people that have said, well, we're in favor of eliminating the real estate tax. I want to point something out. Not one that I have seen is true to that statement. The only way to achieve that statement is to wipe out the fraudulent school district bond debts that the school districts have created. And the only other mechanism to supply the required money for the municipalities and the O&M, operations and maintenance of the schools, is the uniform state sales tax. A bill being put forward that simply says, well, we want to eliminate the real estate tax without closing the loops, and in fact, allowing a school district to go and create additional bonds, is not eliminating real estate tax. Any other bill that's out there, doesn't matter whether it's in Texas or across the United States, it just simply says, we want to eliminate real estate tax, is completely useless. Again, just sucking up air, doing nothing. There's only one solution to this, and that is the full, unmitigated repeal of the real estate tax in favor of the uniform state sales tax. That's in the bill that I submitted to Helen Kerwin. And what it also has is a prohibition against any school from ever raising another bond, period, end of paragraph. That must occur because clearly the problems that have been created here and the fraud, these people can never be trusted again. You cannot let this go out of hand. That's why we're fighting this problem, because it is completely, irrefutably fraudulent. It is criminal. It's their own documents, their own videos, their own testimony. All of it's on mockingbirdproperties.com/DCAT. Every stitch of this is out there. So this bill literally closes the door permanently on every school district in Texas from raising 10 cents in another bond. It's over. And within the first 90 days of this bill getting signed, those school districts must prove to the public via transparency that they can in fact pay off their bonds within 3 years. If they cannot, they must take immediate bankruptcy. This is the solution to the problem, not just in Texas, but across the United States. And I want to take it up one more notch. We've sent this information to Bill Pulte, who is the grandson of Pulte Homes, and he's now with the government, Freddie Mac, Fannie Mae. This has got implications in many pockets, including their bonds and their mortgages. But in particular, the school district bonds cannot be paid off because mom and pop do not have the median household income necessary to pay them off. All of that is outlined in the Godly Texas spreadsheet that was attached to this bill, which is a major point because it shows that the cost of these bonds in these school districts is going parabolic, which means mathematically they cannot be paid off. There's no justification, there's no money, it's an impossibility. You're going to have to face it now, or every day that goes by, the cost of this interest carry is going up by the nanosecond, just like the US national debt. And although this may only be 5% of the total US national debt plus unfunded liabilities, this is the case here where the tail is going to wag the dog. This is bad. We have the solution. We're telling everybody that has participated in this, you are in fact a criminal. You have the, and if you keep turning it down and keep punting, there's going to be a problem. So that's what is in this bill. It's all laid out. It shows mathematically how it gets fixed. It shows what the problems are. And then just a few days ago, that workup that Travis showed you on the hunger in Texas. Well, that's 4 million people that are hungry and don't have the food necessary to feed their family. So they have different programs, and that's what's outlined in that document. The point of the matter is repeal the real estate tax, and they've got all that money in their pocket. I just proved it mathematically, and then that problem gets fixed for the most part. You might have 4 or 5% that still need help, but the majority will be able to survive on their own. The problem is in the real estate tax. The problem is in the monkeys in the middle that have caused this problem, that refuse to fix the problem because they're using your taxpayer money and putting it in their pocket. And to the case of Denton, well, we figured out that $7.5 billion worth of wasted dollars disappears the second those real estate taxes are eliminated. That's just the cost of operating Denton County, what's happening there. It all disappears. Get rid of the fat in the middle, and it's all fixed.
Okay, so good job, Mitch. Couple things, a couple comments here. Travis, may I say I feel like you spent the majority of your time protesting, quoting the law and code first instead of presenting your evidence first and following up with code and law. It was really hard because I didn't get my time. I never even got 8 minutes, and this was every single time I tried to present my evidence. And the reason I started with law first is because they didn't know it. And also because I knew that there would be people watching, and I wanted the people that were watching to understand the law. So the law is, the law is supposed to take precedence. So I started with the law first. But this next time I go, I don't know, now that everyone is starting to understand the law, I may just hit them with the evidence. Another thing here, are you guys working with Governor DeSantis on ending property taxes in Florida? We've sent stuff out. I know Mitch has some acquaintances in Florida that, or according to them, I think they're reaching out to DeSantis. DeSantis, is that correct, Mitch?
Yes, as a matter of fact, I have a 2 o'clock conversation with one of those people today. So,
Oh,
yeah,
today?
yeah.
Okay, awesome. Let's see here. There was someone else that says if we eliminate, I can't remember where it is, but if we eliminate property taxes, boom, boom, boom. If we eliminate property taxes, then they're like, well, then just the consumption tax will go up. I'm like, well, no, not just, because another just, then you'll just be able to really own your property and not be kicked out on the street. That's one thing. They can't take our properties. That's a really big thing. So, and then plus you can farm, you can do your own, you're not forced to do certain things, but you are forced to leave your house under threat of arrest and gunpoint if you stop paying your property taxes. We really don't know. Plus it's against the Constitution. So, I mean, we can dice this up. Also, last thing for you, Mitch for governor, just let us know when you're going to run. I mean, yeah, I think that would be a huge deal. And then let's see here. P Nice wants me to do a documentary on Mitch. I want to see a day in the life of Mitch Vexler. It's pretty boring, man. Other than when you're doing gardening, that's my favorite part about what Mitch does is his gardening. It's an unbelievable garden. But yeah, I mean, I guess we can, right? I feel like every day is a day in our life, so Mitch, right? It's a little mini documentary on what we're doing, how we're trying to eliminate property taxes, but it's just a lot of work, right? Let's see here. Boom, 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 boom. What or not would you help us, right? Like if people aren't understanding, help us to understand this is complicated. We need everyone's help, but as long as we stay calm and respectful, I mean, it's not going to be, it won't be difficult. We are going to go back to doing morning lives as well, you guys. Again, I've been recovering, and I know that I've gone off track because I went to Kerr for the flash floods. It was important for me, even though I was injured, my Achilles, I pulled all the ligaments in my Achilles because of a bone spur that's sticking out of my heel. Still went there, got off track, came back, got assaulted. So I've been off track. We're going to be coming live to you probably twice a week. We'll be doing a lot more videos to get back on track. So really appreciate you guys. Other than that, again, you guys, check out our websites, come back to this video, and definitely appreciate you guys commenting. Appreciate your support. Look out for our evening video. We're going to be back. Mitch Vexler, why don't you give them the last words?
It would be very helpful because there are people on a national level now starting to reach out. So if people that are watching this video can start forwarding to your local press, your local stations, what's going on here, that would be very impactful because there are now national people that are starting to reach out and asking Travis, and we're actually going to speak to a congressman probably within the next hour and a half. So it's the combination of all these things because the evidence is now irrefutable. And what happened to Travis just proves the necessity of carrying this forward. So this is independent of all I have done with regard to Denton Central Appraisal District and the lawsuits that we have filed. Now there's full-blown criminal charges coming back because they actually broke criminal law in the way that Travis was handled. So there's more than one way to skin a cat, and they are the gift that keeps giving. And I made a quip on Chris Martinson's video that these people just can't be this dumb, and I keep getting proven wrong. And what happened to Travis is the ultimate proof of that statement. So it's now time to take this national for a slightly different reason. It ends up in the same point, which is the real estate taxes are illegal under 16th Amendment to the US Constitution. It ends up there. It also ends up in RICO. But the point being that Travis is you. Travis is mom and pop. And mom and pop don't deserve to be assaulted when they go to a central appraisal district, which proves the point of why the central appraisal districts need to be shut down, period.
And also, you guys, on the picture on the right there, I know I needed to cut my nails. Okay, I know that, but I told you I just got back from Kerr, Texas, flash flood. I didn't have time to. I hate my nail right there, Mitch. I hate even more the trespass and the assault. Those are worse. But just wanted to make that comment. You're 100% right. So, you guys join us. If you've already emailed them, go and get, Melissa's information. I got the trespass order. Email her, ask if you guys are curious, how could you trespass someone from a public office when they haven't committed a crime? And have you even talked to Travis? Have you even talked to him? Did you fill out a false police report? Is that what happened here? And why wasn't the chairman arrested for assault? Why wasn't he arrested? I would have been arrested. Why was I kicked out? Why was I trespassed? Why did they shut me down? Why did they not let me read the law into the record? I got so many questions, but I will tell, I don't have a question about my civil rights being violated. I know that beyond a shadow of doubt. And also what's really depressing is police chief in Conroe. I mean, he punted this. He's like, nah, we can't do anything. It's between you and the cat. I'm like, well, sir, you will kidnap me and take control of my body. So I will say that, yeah, actually it's between you and I as well. And I'm like, I'm sorry that the cat has entangled us both, but you are part of this. You issued the trespass. It was illegal. You refused to remove it. You are now a part of this. If you would have done the right thing, that's the Conroe PD, and it breaks my heart more than people understand. If they would have done the right thing, they wouldn't be named. But because they didn't do the right thing and they refused to protect the civilians, to refuse to protect me, and they allowed criminals to assault me, and they allowed criminals to trespass me, you're no better. And that hurts me to say. And other than that, guys, I hope you're out there. I'm sorry, for my energy. I'm feeling a little bit sick. We're going to keep kicking butt. Follow the links. I love you guys from the bottom of my heart. I cannot do this without you. We can only do this together. I am nothing without you guys. Obviously, God as well, and my family. I know that. But without you guys, I am nothing on this channel. So thank you guys for following along. Other than that, if you guys are out there just fighting for your lives, whatever it is you're doing, you guys already know we wish you luck, and we hope you win. Thank you, guys.